Hello, I'm Pat O'Hare, Chief Market Analyst for Briefing.com. Today is Monday, September 8th. Less than 2 months ago, Treasury Secretary Paulson went before Congress and metaphorically asked for a bazooka to help in the funding fight for troubled government-sponsored enterprises, Fannie Mae and Freddie Mac. Mr. Paulson essentially argued that the mere thought of that type of firepower at the Treasury Department's disposal to support the GSEs would prevent a worst-case scenario of the GSEs failing from unfolding. The theory was understandable, only the Treasury Secretary misgauged the fight in the market as a gunfight, when it was really something more like a ballistic missile fight for which a bazooka wasn't going to cut it. In due course, the market quickly showed that it wasn't intimidated by the bazooka line. Confidence in the GSE's ability to raise capital at attractive prices continued to deteriorate despite the Treasury Secretary's thinking on the matter. That confidence crisis was reflected in their plummeting stock prices and widening spreads on their debt. The erosion in confidence seemed to come to a head last week when PIMCO's Bill Gross, manager of the world's largest bond fund, said it is essential for the U.S. to step up and buy assets to avoid a, quote, financial tsunami. At the same time, he implied that he wasn't going to put more money at risk in buying distressed mortgage debt until the government took steps to rid the market of the uncertainty that was driving down prices. While it is safe to say the Treasury Department has been busy exploring all of its alternatives in recent weeks, Bill Gross's stance had the hallmark of being a clarion call that forced the government to act sooner rather than later. Over the weekend, it was announced that the GSEs would be placed in conservatorship. That is, the government would be taking them over. As a consequence of this move, the CEOs of both GSEs were ousted, and the shareholders of the common and preferred stock were basically hung out to dry while the government attempts to stabilize these businesses. Interestingly, the common equity was not wiped out, but holders of the stock have gotten the message that they are last in line to reap any spoils of a successful turnaround effort. The government will get $1 billion of senior preferred stock and warrants that translate into ownership stakes of 79.9% in both Fannie Mae and Freddie Mac as part of the takeover. For good measure, the dividends on common and preferred stock were also eliminated. The stock prices of Fannie Mae and Freddie Mac are down 84% and 79% respectively in the wake of the government's actions. Notwithstanding those individual stock moves, the takeover plan has been interpreted around the world as the right move given the systemic issues involved. The ultimate design of the government's action is to ensure there is liquidity available for mortgage financing efforts and to help stimulate demand in the housing market such that the pace of price declines, delinquencies, and foreclosures abates. As part of its plan to instill some confidence in the mortgage market, the Treasury Department intends to buy $5 billion of mortgage-backed securities on the open market. It is believed that the government's intervention here will help bring down mortgage rates, which would help bolster housing demand. For the market, though, the key consideration today is that the government intervention takes away the uncertainty surrounding the GSE situation, not only on the funding side of the mortgage equation, but also on the repayment side, as holders of GSE debt and their mortgage-backed securities can be assured of repayment. This act still is not a cure-all for the housing market. However, it can be considered an inflection point that should bolster confidence in the notion that we are closer to the end of the housing crisis than the beginning. I'm Pat O'Hare for Briefing.com. Thanks for listening.